I want to take a few minutes to thank the Bureau for having us on today to really talk about a topic that it probably, I'm guessing everybody on this call has faced at some point, and these are different cash flow mistakes that we make as business owners. With that, before I get started with that, I want to kind of give you an idea or give you some background on who we are so you know the perspective that we're going to be giving you today. Summit CPA Group is one of the largest distributed CPA firms, if not the largest in North America. So our team is spread completely throughout the United States. We have about 40-ish employees, a majority of being CPAs. With that, one of the largest services that we offer actually two services, and the largest is the virtual CFO service by far, in which we service about 100 clients throughout North America. Our primary focus are clients in the creative agency space, so folks like yourself, which we work with on a regular weekly basis. So you could pretty much say that we're the largest virtual CFO firm servicing creative agencies as of today. So it kind of gives you some perspective where we're coming from. So what we're going to be talking about today are things that we see over and over and over again with creative agencies and different mistakes that they make as they're running their business. So we're going to focus primarily on the 5 cash flow mistakes. And in talking about those cash flow mistakes, the first mistake we're going to talk about is not having a cash cushion. We're going to then move on to taxes. What taxes? Third mistake, not having a solid forecast. Fourth mistake, not reviewing and updating budget, not paying yourself what you're worth. And then the fifth mistake we're going to talk about is not staying on top of invoicing. Each one of these different areas we're going to spend some time on and go through, and then towards the end we'll leave some time for questions. So let's get started here, not having a cash cushion. Well, how much cash should we keep on hand? That's a question that we get asked all the time. And the importance of knowing the answer to that is that we want to keep a minimum of 10% of annualized revenue on hand at all times. But we don't want to stop just there. So we want that to be between 10% to up to 30%. So 10% equates to about 2 months worth of expenses, 30% equates to about 6 months of expenses. Well, let's count how we would actually calculate that. So in looking at basically a profit and loss statement, looking at revenue being that top line there, the $3.4 million, we take that $3.4 million and multiply that by 10%. So in this case, for this company, if that was annualized, the last 12 months of annualized revenue, we'd be looking at having about $350,000 in the bank at all time. And then if we look at more of a 30% look, then you're looking at about $1,050,000 in the bank. So the range varies pretty dramatically, 349,000 to 149,000. So now let's prove the math on that so that you can kind of get an idea of what your cash flow should be, and you know what that percentage should be. So again, the rule of thumb is 10% to 30%. Where do you fall in that mix? We're going to kind of walk you through the steps here to actually determine that. So here's the formula. Looking at annualized revenue divided by 365 days times your usage, which is your AR days less your AP days, accounts receivable less accounts payable, and that's the cash you need on hand. And this is actually the same formula that you should use when determining your line of credit need. So again, the same thing, cash on hand, cash flow cycle is going to determine line of credit. It's also going to determine how much money you need to have in the bank at all times. So let's do some math. So let's look at that $3.4 million company we looked at before. Divide that by 365, which gives you $9,581 per day in revenue is what this company is generating. We take that and multiply that by the AR usage. We're going to say that typically they're 45 days out all the time. So when we invoice, we give 45-day terms. And then we're going to less our AP. And we find creative agencies always pay clients, always pay their vendors fairly quickly. So they're going to say the AP turns 5 days here. And so subtracting the 2, you get 40 days. So then we take the 9,581 times 40 days, and that comes out to $383,000. So in this case, looking at this company, if those are the numbers that we're looking at, the AR days and the AP days, we're saying, well, they need a little bit more than 10% in cash all the time, or $383,000, just to go through their cash cycle. And so again, it's really important to understand that. Where do you fall within that range? So now, why would anybody ever want to have 30%? That seems like a lot of money in the bank at all times. Well, there's really some really solid reasons. Why would you want 30% versus 10%? Well, 10% if you're having more of a high reoccurring revenue, so you have reoccurring revenue all the time, a lot of different accounts in there. Your accounts receivable closer to zero. You know, you have 10 days, 30 days, 15 days, you have some really, really good accounts receivable. Your pipeline is very strong. You have young partners, low growth, no big purchases in the near future, one owner. Owners have high personal liquidity, no clients greater than 10% of revenue, and high amount of accounts receivable. So if you meet all those criteria, then you want to stay towards that bottom end of that 10% scale, or in this case, we looked at it, it was about 11% for this client. Now, on just the opposite, the further you are away from that, where you have no reoccurring revenue, high receivable days, weak pipeline, partners that are retiring, high growth, multiple owners, big purchases, all these different things, high concentration on one client, we see that a ton, then you want to have a lot more than the 10% because you want to be able to sustain that, that cushion there in the event that something really goes bad in your company there. So again, 10 to 30% is what we recommend at all times. So now how many bank accounts should I have in order to achieve that 10%? Well, we have what we call an operating account, and the operating account is what you pay your bills out of, right? And so we're always going to keep 2 payrolls in that operating account. So whatever your payrolls are, times 2, that's the minimum amount you're going to keep in the operating account. Well, we want to make some money for the money in the bank. So if we've got $1 million sitting in that bank account, we don't want it all just sitting there not earning anything. So we're going to have the remainder amount of your cash, we call the cash reserve, is going to go into this reserve account. And hopefully that's more of a savings account in which we can actually, earn 1.5% interest. There's, some banks out there. If you do a search for savings accounts with interest, you can kind of see some banks out there that you can actually, put your money in and make a little bit of money. And then you want to have the line of credit. So, a lot of people say, well, I never want to get into my line of credit, never want to use it, whatever. The easiest time to get the line of credit is when you don't need it. We highly recommend getting the line of credit based on the formula we talked about before. And that way that you always have it in the event that things go wrong. Because when things go wrong, you're not going to have that opportunity. So it's very important. Then the third account, which we're going to talk about here in the next in a few minutes here, is your tax reserve account. And so I just showed you how much money you need in the bank account, that $380,000 to $1 million. And that's in addition to that, you're going to have extra amount of money set aside for taxes. So it's not even including the money in our cash reserve, so completely separate. So how much do we get in our tax account? Well, that's our second mistake. Taxes, what taxes? Often we get clients all the time that come in, big, huge surprises in April, and that's why they came to us, because they didn't want that surprise. And so there's no reason that surprise should ever happen, where in April comes around and you're thinking, wow, I wish I had known this before. I wouldn't have spent the money on XYZ or taken the money out of the account or whatever. So we want the company to pay for the taxes, and so we want to make sure that we set aside money, specifically for that. And so again, with our accounts, we've got the 2 accounts that equal our cash reserve account, the 10 to 30%. We're going to have the additional account set up, which is going to be based on net income and not revenue. So instead of revenue, we're basing this on net income, and we're going to base this on forecasted net income. Again, forecasted, not actual, but forecasted net income, and it's going to be 40%. 40% generally will cover that for the company. So how does that work again? So we take our example here on our accrual-based profit and loss statement here. And in this case, we've got it broken out. 3.4 million is the revenue. If you follow to the bottom there, $655,000 is the net income. So if you take that amount times 40%, you come up with $262,000. So that's the amount that we're going to set aside for taxes to be paid the following April. So assuming this is January of the year, the following April, we're going to have make sure that money is set aside to pay for that. Well, how do we do that? Well, let's take a look here. So looking at the timeline here, April, June, September, December, and then again April, those are the payments. That's when Uncle Sam wants your quarterly coupon or quarterly payment there. And so we're going to actually pull money out of the operating account every single week, or at least once a month, for the amount of that 262 divided by the number of periods you're going to pull it out. So if it's on a monthly basis, $262,000 divided by 12. Weekly basis, 262 divided by 52. It doesn't make any difference. I like to pull it in small increments. It's a lot easier on my psyche by doing that, but again, that's completely your call. But again, do not wait till the quarter comes around, because you'll find an excuse to pay or to put that money elsewhere. Do not wait half the year. Definitely do not wait for the end of the year, or you're going to find that you're going to come up short. So again, really important to set aside little increments every single month, have it drafted directly into the account. That way you've got things taken care of. So now, do we send that money quarterly to the IRS? Absolutely not. We only want to send the minimum amount that we're required to the IRS. And so as your tax preparer wraps up your tax return, I'm going to assume that most everybody here is going to be a flow-through entity like an LLC or an S Corp, that they're going to go ahead and create what we call these estimated payment vouchers, or the quarterly coupons. So again, it's really important that we set aside the money on a regular period and only pay the coupon amount. So we're in this example here, we're going to say that the company's coupon amount was $50,000. So $50,000 every quarter. $200,000 is roughly what they this client would have paid in taxes last year. So how does this work? So we set money aside on a weekly basis or a monthly basis, accumulates to 65. We just sucked out $50,000 of it, so dropped it down to 15.5. We're building it back up another 65, which totals now $81,000. Again, this is a running total in the bank account. June 15th comes around, boom, we sucked out $50,000, sent it to the IRS and the state agencies there, which then drops it to $31,000. We add another 65.5 over that period of time, the next few weeks, which generates and brings it up to 95.5. Again, Uncle Sam gets his portion in September 15th. We drop another $50,000 out of that bank account, leaving about 45.5 in that bank account there. Again, building again, bringing it to $112,000, sucking another $50,000 out when that fourth quarter payment comes due, which leaves us $62,000 in the bank. So again, we've paid $200,000. We have $62,000 in the bank. And then when April 15th comes around, the money's already set aside, out of sight, out of mind. We use that money then to pay Uncle Sam the remainder amount on April 15th. So again, a very logical way of doing it. But for a lot of people, they wait to the last second. And again, waiting to the last second is huge troubles. And again, you don't want to use the IRS as a bank. Use your own cushion there, set that money aside into a separate bank account, and then make your quarterly payments as necessary. So how much money should we keep on hand? Again, as kind of a recap, operating accounts, definitely 2 payrolls, pretty simple. Cash reserve account, the remaining amount in the bank there. So the remaining amount, and again, that's hopefully on some sort of interest-bearing account. Tax reserve account, 40% net income. So we have 3 bank accounts, and then we have the line of credit. So all 4 are very essential in this process to make sure that you can maintain the cash reserve or cash, the right cash that you have in the bank at all times. Extremely important, because you don't want to end up on the other end, because again, cash is king when it comes to running a business. So let's recap. 10 to 30% of annualized revenue is the solution for mistake number 1. Mistake number 2, 40% of forecasted net income. So again, those are the 2 solutions for those 2 mistakes. So let's move on to the third, and that's not having a forecast. Oftentimes, we find that, for most owners, that they really don't understand the capacity that their team can actually produce. And so developing a forecast is very difficult for them. What we want to do is we want to develop a forecast that they can actually use and rely on throughout the year, so that they can make those informed decisions. And when I talk about forecasts, I'm talking about the top line revenue and how that impacts everything on the financial statement. So we're looking at top line revenue. We're looking at budgeting, I'll talk about in a little bit, and that's going to be on the different expense accounts and how all that impacts cash going forward. So let's talk a little bit about the metrics involved when forecasting cash. So there's many different steps. As you can see, we broke this out from January through December, so on a monthly basis. It's important to do it on a monthly basis because all these metrics change based on the circumstance that happen within the month. So don't just try to do it on an annual basis or a quarterly basis. Do it on a monthly basis. That way you can kind of see your true numbers. Because what might happen in January as a 100% goal might be a really bad thing in October. So again, the months may not jive completely. So the first thing we're going to do is we're going to look at our working days, and so you just simply take the calendar out, count the working days, leave out the weekends. So in this case, we've got 21 working days, as you can kind of see right there, and you can kind of see February jumps to 21, March is 22, and they vary. So again, we're not taking out holidays, we're not taking out vacation days, we're only looking at working days. And so we take those working days and we multiply that by 8 hours a day. So again, this is what we're paying our team. So with that, we pay our team on the average of 2,080 hours a year. So again, 2,080 hours a year is what we expect our team to work. Now, we don't expect them to work every single hour of that, right? Because we have what we call culture hours. And those culture hours can be many, many, many different forms. Many times we'll have holidays in case in some companies, and it's going to vary company by company, but some companies may celebrate 9 days of the month of the year. Others may have 7, others may have nothing. Vacation days, we may have 3 weeks for some companies, 4 for others, 2 for others, maybe a combination or a hybrid for others. So again, that's going to vary from client to client. Others are going to send their team to different educational events like bureau events where they're going to spend the week educating and not billing or not working. And I say not working, they're truly working, it's just not billing towards clients. For distributed companies, you'll have company retreats. You may have 2 of those a year, 1 or 2 of those a year, so you've got to take that into consideration. And then you may have specific things that you want your team to work on internally that you're not going to build, maybe R&D projects, internal projects of some sort, or maybe giving the people time to roll off one project to the next. If they're working on a really long project for a long period of time, maybe it's a week before they roll off to the next one there. So we have to bake all that in there. So in this case, our total culture hours would be 408 hours. This is going to vary dramatically from company to company, so you need to go through and calculate, what you spend on culture hours. So the next step is you take that 2,080 that we just calculated there, subtract out 408 culture hours. So we have in this case 1,672 hours that we can bill clients. Yahoo! Now, does that mean that they all get billed to clients? Well, no, obviously not. When we look at a 40-hour work week, we have to decide how much of that week do we expect our team to bill towards projects. Now, in some cases, it's we want, some firms say, hey, we want 100% of it billed towards clients, so 40 out of 40. Some are 80, percent, maybe 30 out of 40, or maybe, it varies dramatically. Again, this is based on your weekly expectations. So we see the range go from 28 on the low end to 38 on the high end. Again, it's very difficult to have 40 just because you've got admin time, meetings that you can't charge for, that sort of thing. So again, you have to, as a company culture, you've got to come up and decide again what that number should be. And so in this case, this company, we're saying it's 75%. And so we take that 75% times the total hours worked. And in this case, we have 1,254 billable hours that we expect this individual on the team to bill out every single, for the entire year. So now what does that mean? So now that's the first step, kind of getting into our utilization there. Next thing we look at is, what we expect them to bill out. So looking at this company, for example, the top line there is the standard rate, and the standard rate is what we actually charge a client. So that's what's on all of our estimates. We're taking $180 per hour. However, we find that a typical firm will, at a minimum, lose about 10% off their estimate, and that's where the hours they actually work on the job take longer than what the estimate is, or maybe they can't bill for it. Anytime that we see greater than a 10% fall off between what we call the standard hour and the average bill rate, that's a problem, and that needs to be addressed. That's either going to be a problem in the quoting process or a problem in the project management process, or maybe a combination of both, or maybe just a big time, really bad client type of thing. So we need to be able to figure what that is so that we know that there's no leakage anywhere, and again, be able to address that. So in this case, we just said, hey, it's 10%. Don't know what this company is, but let's assume it is. And it's really simple to figure out what your average bill rate. You just take your revenue divided by the number of billable hours into, your billable hours, and that comes out to your standard rate. So it's pretty simple calculation there. but in this case, we're going to say it's $164. So kind of getting back to our model there, we remember we had 1,254 billable hours that we required this person, an average bill rate of $164. That comes out to an individual revenue of $205,000. So in this firm, based on all the different things we said there, we're billing out at 180. They're utilizing, and they have only 408, culture hours, and we're backing into their billable hours there at 1,254. We expect this company to have $205,000 basically per individual. Now looking at January through December there, as you notice, we don't just simply take that individual number, divide it by 12. We base it on the billable hours in that specific month. So if you're looking at January there, we've got 114 billable hours times 164. We expect that individual to earn about $18,000 in January. But if you look over into November, where maybe we have some vacation time expected, or on the average vacation taken, we're only expecting that person to bill $10,827 in that month. So again, it's important not to divide and then say, hey, yeah, there's a great month, a bad month. You've got to know when to expect that revenue to come in, because you don't want to deceive yourself and think things are going well when they're not, and then again, vice versa there. So looking at $205,000 per producer. And let's say this company has 20 employees and 17 of them are producers. You'd take 17 times the 205, and that's what your forecasted revenue should be based on that annualized year. So $3.5 million is what we expect. Again, same math that we talked about before. In February, we expect the team goal to be 351,000. In May, 234. June 317, and then November we expect 184. So again, very important to be able to outline this on a monthly basis and kind of see where you fall and how you break that revenue out. Again, it's going to be important so you can kind of track how you're doing on a month-to-month and compare yourself to that forecast. So if you're not hitting your forecasted numbers, why? Is my billable rate too high? Am my utilization too low? Am I really messing those up there? I need to figure out exactly the right formula so that I know for certainty what my team can do build on capacity. Well, it doesn't start just on capacity, because it'd be great to say, hey, I can do $3.5 million and it happens. You've got to look at your pipeline and then adjust for that. So when we look at our pipeline, we only look out for really the next 2 months of certainty there and say, hey, based on the next 2 months, can I substantiate the revenue that I'm expecting? So you just simply take January and February, add them up, or February and March and add them up, and look at your pipeline, and does your pipeline substantiate that? And if it does, great, we keep the forecast the way it is. If it doesn't, then we reduce the forecast to what we truly think can happen in that month. Because again, we don't want to fool ourselves when we're looking at a forecast. Again, a forecast is predicting the future, but if it's not happening, right away, we need to know that. And then also, this is going to really help when you're looking at hiring new employees and letting people go, or hiring contractors or letting contractors go, increasing prices and so forth. You can kind of do that based on how you're handling the forecast, because at the end you have to flip that over and look at the balance sheet and say, hey, what is this revenue generating for me that's going to help me out cash wise? So again, it's really important to have that forecast and really understanding what it's made of and what you can actually control in that forecast. The next thing is reviewing and updating a budget. Again, another fourth mistake that many customers run into. Again, looking at the same profit and loss. We're looking at revenue, production, administration, marketing, and facilities. Those should be your 4 or 5 main categories that you have in every company. And then from there, you break everything out. So in production, you include production employees, tools that they use, and so forth. All production-related stuff goes up in production. Typically, we see production expenses about 50% of revenue. Not much more, hopefully, in cases we do see a lot less. So that means gross profit, we want to see between 40 at the lowest to 60% is in that ballpark. Again, 50% is right in the norm there. Then your overhead would consist of administrative, marketing, and facility. So under administrative, make sure that you've got your administrative employees, your firm administrator, your marketing, you should have your marketing team in there, your facility, all your facility costs in there. And so again, you're breaking them out into these different categories. Typically, we see the combination of all three about 35% between admin, marketing, and facility. Facility is about 4.5%. So if you look at the other two, you're looking at about 30%. So now that's including the owner comp. So now I've got the owner comp separated out, down here just for ease of looking here. In this example, the owner comp I've got at about $300,000. So the owner comp is typically, when you're analyzing your own stuff, going to be put into one of those categories. So where does the owner fit? Is the owner a producer? Slide the owner up in the producer category. Is the owner a marketing person? Slide them in the marketing. Are they a combination of both? Take 50% of the owner and put it in marketing and put it in production. Now, you don't do that in your accounting system. You do that outside of it if you're kind of comparing and seeing where everything falls. So again, very, very important. And then when you drop everything down to the net income, you want your net income to be between 15 and 20%. And again, that varies dramatically as you get bigger and small, the bigger you get. And we'll kind of go through what that's going to be and what your income should be and everything as we go through the process here. So I'm going to show you how all that breaks down. So looking at a budget, again, you budget based on all the different accounts spread out throughout the entire month. So again, January's budgets numbers aren't going to look the same as February's, because you're going to go into February and find out the exact expenses and allocate them in the right period. So you can kind of see what your net income is going to be at the end of every specific month. But let's look and kind of compare company to company on just the size of the companies to give you kind of a good understanding of where you should fall within that. And I broke them out under just three different things: profit margin, owner comp, and expenses. So where should owner's comp be? Where should profit margin be? And then where should the expenses fall? Well, in looking at things, I like to look at it first and say profit margin should be 15%. Okay, 15% if you're a $500,000 to $1 million in revenue company. Where should owner comp fall in there? 20%. So owner comp should be 20% in that same bucket there. So between owner comp and net income at $1 million, you should have $200,000 in revenue, as the owner compensation. Again, that's all owner compensation: health, salary, the whole works, life insurance, everything related to the owner. If they have automobile expense, that would be in there too. 15%, again, is the bottom line. That's after owner comp. And so it should be about $150,000 in the bank there. Then the remainder of the expenses between the production team, which is generally 50% of revenue, and then admin and marketing should flow into the other buckets there. And now you're going to kind of see this kind of change a little bit as we go to the next stage. So if you're about $1 million to $5 million, it's going to change a little bit. You can kind of see net income stayed the same, 15%. We always want you between 15 and 20. That's a high five. But you can kind of see owner comp drop 15%. Now, it didn't drop in dollars, it dropped in percentage, because again, you've got a bigger pool of money that you're going to be getting a lot more from. So your owner comp actually increases as you actually bring on revenue. It does not stay flat. If it stays flat, we've got an issue there. So we want to make sure that that's always increasing. And then the remainder, about 70%, covers the expenses there. Now, when I do say owner comp, that's for all equity owners. So if you've got two equity owners, multiply that 15% by wherever you're at. Let's say it's at that $1 million or $5 million mark, and then divide that by 2. And that's typically what the equity owners will make in a company. So if you have 3 equity owners, you do the same thing, divide it by 3. So again, that would be equity only, isn't that owner comp. If you've got a non-equity partner, which happens a lot of times with phantom stock and so forth, then that goes in the 70%. So that's in that overall expenses of the company then. So again, making that very clear so everybody's on a consistent basis. Owner comp, 15%. Again, only equity owners, and then the non-equity owners go into the expense category. So let's look and see what it jumps up between a $5 to $10 million revenue company. So again, now we go from 15% to 10%. And so again, it's getting 10% within that mark. And again, it's not 5.1, it goes to 10%. It graduates into that 10% to where at the $10 million mark, you're at that full 10%. So you can kind of see where it goes from down 15 to the 10%. So again, don't just jump and say we're at 6 million and say, oh, now we get 10%. That's not how it works. It's a graduation to that 10 to give you a ballpark idea how much that owner comp should be. With that, also, we should have 15% net income. You can see net income has never changed in my example here. Then the remainder, 75%, falls in the other. Now, if you can exceed these numbers, perfect. There's nothing wrong with that. Great, high five. You're doing a great job. If you're falling way short of these numbers, you need to look and see, hey, where are we falling short at and why are we falling short at it? And that's the importance of having that clear forecast, clear budget, spread out, and then taken care of in this manner here. So again, really important to understand where you fall based on your revenue level. And then if you get over $10 million, you can kind of see again, it went from 10% to 5%, net income stayed the same, and now you got 80% because now we've got a board of directors. We got all these different functions that are running our company that we didn't have or didn't need when we were a $500,000 company. We do have at the 10 million. And again, that kind of graduates all the way through. Again, these are ballpark numbers. There's no exact numbers, but this will give you kind of an idea on where we feel you should fall. Again, at a 15% net income, in all cases there. So we to kind of prove those numbers there, we looked at a company called PayScale, and PayScale, very large pay software or pay provider out in on the West Coast, and they deal with many companies across the nation. So to give an idea, hey, how much does a typical CEO of a company make? Again, this would be a CEO based on owner or based on number of employees now instead of the dollars I just went from there before. And you kind of see based on that, between 0 and 5, approximately $120,000 is what a typical CEO, if you can call that person at a 5-person level or an owner of a company. 5 to 10, it jumps to about 150. 10 to 20, about 190. And then when you get over that 20 mark is where it starts increasing pretty rapidly. And I'd say roughly 230,000 would be a good starting point between at least 20 and 30. So again, that definitely goes up and gets a faster incline as you get bigger and bigger in the company. So again, reviewing your forecast and budget regularly. There's 4 different, basically a quiz here. Which one, which one am I going to recommend? Well, I'm going to say annually is way too late, and unfortunately, that's what the majority of the creative agencies that we've worked with in the past have come to us looking at their things annually and generally only after tax returns completed. And at that point, it's just too late to make any kind of informed decision. Quarterly is also too late. They do that quarterly a lot of times. Maybe their accountant will come in to review quarterly payroll taxes or whatever and kind of take a sniff test of their financials and see how they're doing. Highly recommend quarterly out the bucket. If it's 3 months down the road, you're too late and you can't really make those proactive decisions. The 2 answers here, again, you're probably going to think I was going to cross off monthly and go to weekly, but both of these are perfectly fine. The smaller the company, you're going to need to look at those financials all the time. Look at your numbers all the time to see where you're at. If you don't have a lot of activity in your company, well, then maybe monthly is okay. But with that, I would say between weekly and monthly, for the most part, everybody needs to be looking at their forecast. Everybody needs to be looking at their budget. Everybody needs to be looking at cash flow, at least on a weekly basis. So again, really important to make sure that you stay on top of these numbers all the time before they get out of control. Because once they're out of control, it's very hard to reel them back in. So kind of recapping mistake number 3, again, the solution is creating a dynamic forecast. Mistake number 4, the solution there is managing a budget regularly and paying yourself what you're worth. Don't be the last person there to get paid. Be the first person. Budget that in there. Here's what my salary needs to be, and here's what my expenses need to be. When you budget it in there and you actually do it, for some reason it's kind of weird, but it seems like everything just kind of works into place. But the reverse also happens. If you don't budget your salary and you just take what's left over, the opposite works in your place. There's nothing left over, and you're working for really pennies on the dollar. So now getting into mistake number 5, not staying on top of invoicing. This is kind of a dynamic one that I'd like to kind of just really briefly talk about, but kind of the force of it is just dramatic. And a lot of times we get clients coming to us and saying, you know what, we got these great terms, 45 days or 60 days, or I'm going to give them 60 days because it's a big client, or, what does it really matter? It's not like we're, doing anything. It's not like we're losing money or anything. And in the case, you're not. But let me give you an example how it all works. So staying on top of your invoices, let's say this is your current situation. And so if you look at the blue line and then you look at the solid line at the $0 amounts, that's your money. So in February of this example, we've got $20,000 in the bank. In March, we're on our line of credit at 30. In April, we're at 80, and then we're at 150 at 60 at that May mark there. So again, typical kind of roller coaster ride there. And we find that, hey, we're turning our invoices every 60 days, meaning that no matter if we agree on it at the start and say it's 60 days, or we say it's 30 days and they don't pay till 60 days, makes no difference. We're getting our money every 60 days. And so it's really important to see the dynamics on what happens here. So let's go ahead and say, hey, we just increased that by 15 days. So now we say we dropped our schedule from 60 days to 15 days. What happens? Well, we started at 20, we're still there, right? 50 is where we would be in March. So instead of borrowing a line of credit, we actually have a little cushion there, $50,000. In April, in this example, instead of 80, we have $200,000 in the bank. And in May, instead of 150, we have $230,000 in the bank. Man, wouldn't that make you feel a lot more comfortable having 230,000 versus 150, or even $50,000 in the bank versus borrowing line of credit? Well, let's not just stop there. Let's skip the 30-day and jump dramatically up to that 15-day. So the 15-day would mean that you've got a lot on retainer. You're getting a lot of your payments up front. It's all reoccurring. The deals you're putting in place, let's say, are 30 and 45 days. So if you've built your retainer to about 50%, you're getting those on a monthly basis, or even in advance of the monthly basis, and then everything else is working out fine, which is a very typical, very typical example. Oh, and by the way, 45 days is the industry average to give everybody an understanding of that. But let's say that, hey, we exceed industry average there, we're at 15 days. Wow, look at that difference there. So we went from $20,000 in the bank in February. Instead of borrowing our line of credit in March at 30, we've got $170,000 in the bank. April, instead of having the 80, it's 360. And then in May, we're at 390. Huge difference. So when people say, man, that's really tough to build that cash reserve to where you need it, well, you got to take the necessary steps, looking at all your different examples, but really focusing on your cash and seeing where that's going. Now, the reverse, I'm not going to show you the diagram, but the reverse would be true on in payables. If you need cash, then extend your payables out. Don't pay them 5 days or 10 days or 15 days. Pay them at 30, and you're going to see a big jump in cash depending on how much you got in payables. Now, obviously, you can't pay your employees that way, and that for most of the companies in the creative agency space, that's the majority of their expenses. But when you look at it, if you can juggle that and maybe make a combination of that, average 45-day turn, and then maybe 15 to 30 days on your payables, and that's going to get you a little more cushion in there. And again, using that formula that I had at the very beginning there, showing what your cash cycle be, you can kind of see exactly the impact it's going to have in cash at any time. So let's recap the 5 cash flow solutions that we talked about. The first solution, always have at least 10 to 30% of your annualized income in the bank at all times. Hugely important. Number 2, always set aside 40% of your forecasted revenue in the bank in a separate bank account. So you've got your third bank account right there. And then pay only the minimum required by the IRS and state agencies there on a quarterly basis, leaving the remainder due, or remainder amount sitting in the bank until April 15th comes around, in which you can then pay it there. Again, money set aside automatically, so you don't have to think about it and don't make decisions based on having extra cash in your bank when it's already reserved for somebody else. Third one, creating a dynamic forecast based on capacity. Hugely important to understand what your team can actually do. Create that forecast and make sure that it's based on every single month. So again, don't do it for the year, but base it specifically on every single month based on everybody's utilization within that month and the days available and so forth. Solution 4, pay yourself what you're worth and review your budget a minimum of monthly. So again, making sure that you're always hitting that 15% net income mark, that you're always receiving based on where you're at on the revenue side, or if you want to look at the employee side to give you kind of an example, how much money that you need or should be having as an owner of a company. And again, it's not a sin to make money, and that's really important to understand. As an owner, you take on a ton of responsibility, and it's very important that you get compensated fairly for that. And then the 5th one is reduce the accounts receivable days. Don't wait until the invoice gets there, or basically the invoice is past due 15 to 20 days or 30 days past due before you make that call. Always make a courtesy phone call right away. just want to just double check. Here's, make sure you got the invoice. And again, it's not, hey, pay me right away, but hey, double check, got the invoice. I just want to make sure. So there's no problems down the road. Oh, you didn't get the invoice. Well, let me send it to you right away. That type of thing. Always make sure that, because again, for a lot of the companies that you'll work with, their cycles pretty much. If you don't get it by a certain day, you're waiting another 30 days or whatever. It might take them a long time to process it. So it's important that nothing falls through the crack and you're not waiting on something that the client doesn't even know that they got. So again, really important, stay on top of those receivable days. So I hope that's helped you get a good grasp on the different mistakes that we see clients make all the time with cash flow, and basically look at different ways that you can improve on it, and then add to the success that your company should deserve at all times, and pay yourself again what you're worth. Extremely important. Again, now we'll be open for questions.